you very much, Francois, and to Steph as well, and I Squared. Delighted to be with you. Happy New Year to all you who are logging into this presentation. And you will see the heading is risks balanced in both upward and downward direction. In other words, one has a basic framework of expectations for the coming year, but there are some significant risks. But the interesting thing on this occasion is that those risks are not only in a downward direction, but also in an upward direction. And they appear to be balanced at the moment. In other words, as you will hear, the South African economy is expected to grow by around 1.5% to 2% this year, but the chances are that it could go above 2%, and conversely, it could actually slow to below 1.5%, depending on certain developments. Let me go through the presentation now and show you what I mean by this. To begin with, let us look at what is happening right now in the economy. And on the positive side, there is no question that we have seen a positive development in the form of the end of load shedding. We have the formation of the Government of National Unity. There had been a lot of apprehension ahead of the general election, but after that, the formation of the GNU led to a significant improvement in confidence. And that confidence stems mainly, I think, from the perception that populist elements in the economy have not appeared and have not taken over. And conversely, that we now have a government that comprises 10 different political parties and will, in fact, be able to cooperate much more closely with the private sector to find solutions to our problems and encourage higher economic growth. And you can see the effect thereof in the form of the improvement in business confidence in the indices here. It's not dramatic, but it certainly is an improvement compared with a few years ago. And that is encouraging and remains, broadly speaking, in place. In another number of other places, I will show you how confidence seems to be outweighing the actual poor level of economic activity itself. Also helping to provide confidence is the fact that inflation has fallen very sharply to its lowest level in 4 years. And that is also encouraging the expectation of interest rates falling significantly further. And we have had falling interest rates. That has been tempered somewhat more recently by the realization that globally interest rates might not decline as much as we had previously hoped for. Also on the positive side, we've had Moody's revising South Africa's growth forecast upwards, and also S&P revising our credit rating outlook upwards to a positive rather than stable, implying that there is a chance of further upgrades in our credit ratings in coming months and years. And in fact, we had confirmation of this a couple of days ago when Enoch Godongwana, our finance minister, suggested that, in fact, we should be out of sub-investment grade junk status by 2027. That may be ambitious, but certainly it reflects the improvement in confidence. And at the margin also, what has helped in the short term is the fact that the stimulus from the introduction of the two-pot retirement scheme and people's ability to access their retirement funds has actually come to the fore and helped to boost consumer spending somewhat. On the negative side, or on the risks, we have to obviously consider the fact that we are still struggling with our logistical bottlenecks. Last week alone, we had a report that said that there were problems at Durban Harbour due to the effect of the rains there and the damage that they had caused. You cannot underestimate the fallout from the unrest in Mozambique, which has meant that those people, those companies, mineral companies especially, who had diverted a lot of their exports and through the rail network through to Maputo, are now having to scale back on that. And a report came out to say that the daily throughput of exports through Maputo has fallen by somewhere, it depends on which day, but between 40 and 70% since the unrest has broken out. A very big constraint is that one had been hoping to see large-scale infrastructural investment spending. It hasn't happened yet, partly because we keep seeing opposition from within the ANC, certain factions, especially COSATU and the SACP, against the concept of the ANC combining with the DA and approaching the private sector to assist. And in that regard, I can just allude to the fact that this week alone, we saw the Department of State Public Enterprises suggesting that they wanted to get the JSE to list some of our SOEs, which suggests further progress in regard to the attempt at private involving the private sector more effectively. We've had, and then you might ask, but what are the risks of a breakup of the GNU? And the counter to that is that one has perceived that there is such a fear on the part of all parties of what might follow if the GNU breaks up, that alone is serving a welcome purpose. It's almost like the more that countries prepared for a nuclear war, the lesser the likelihood of that emerging actually happen. We've also seen, and one of the big weaknesses that we continue to have is the disarray and incompetence at municipal level due to that has not really been fixed by the formation of the GNU. We find at local government level there are still major political factional problems and reluctance on the part of the ANC to combine with the DA and instead to align with other parties. And this is linked apparently to the presidential succession battle with Panyaza Lesufi, for example, in Gauteng, trying to make a mark which is actually going counter to Fikile Mbalule as spokesman for at national level. Then internationally, we've got possible negative fallout from the election of Donald Trump as president if he imposes substantial increases on import tariffs. That implies a deglobalization and can unravel a lot of the benefits of globalization that we have seen over the last 4 decades in terms of lower inflation and higher economic growth, and ultimately could redound to the detriment of South Africa itself. Also, Trumpian policies of tax cuts threaten to keep the US public debt very high. His policies also of trying to impose the requirement on NATO countries to increase their defense spending is likely to put upward pressure on their public debts as well. And that combined stands to keep global interest rates higher and more elevated than previously anticipated. And to put it in a nutshell, there's quite a lot of confidence that the GNU could see things improving. And in fact, this morning I read the report coming out of Business Leadership South Africa of the progress made in their talks with government, and they're still very optimistic, and there is a definite objective of trying to get economic growth to scale up to 3% per annum by the end of this year. We, of course, believe that that is too optimistic, but it does show you that there are those kind of upside risks. But as of now, we have seen fairly little sign of any major uptick. We know that third quarter GDP growth was very weak and negative again for the first time this year. What's been particularly worrisome has been the lack of capital investment, showing how there are still significant headwinds to infrastructural investment spending, a lot of it linked to the fact that we have these construction mafia interfering with attempts at that. And we've seen the productive sectors of the economy really stagnating. Obviously, the biggest negative was agricultural output, which declined by nearly 30% in the third quarter, although those figures are being contested right now. But that was supposedly one of the big contributors to the negative GDP outcome. But more generally, if you look at mining, manufacturing, electricity, and construction, you can see in the bottom right-hand graph that there's been absolutely no sign of any major pickup. Just before I started this presentation, I got news of the mining output figures for November, still very, very weak. Obviously, the problems in Mozambique are impacting negatively, and port bottlenecks are preventing a rise in exports of vehicles and, of course, minerals generally. And so the productive sector is generally stagnating. And given that that is that's where we are hoping to see employment improving, the converse has been happening, and formal sector employment, as you can see in this graph, has actually been declining over the last year. Fortunately, there is a positive side to the picture, and that comes from the consumer spending aspect, where we have seen a little bit of life, especially in October and November. Retail sales growth in in October certainly picked up to its highest level in many years, and the retail sector is at least 50% higher than it was a decade ago, unlike the productive sectors, which are lower than they were a decade ago. We've also seen a nice pickup in car sales, new car sales, a bit of a setback in December, but it's still showing a bit of an improvement. And this is drawn from a number of factors. Firstly, we've seen that pay increases, including earnings and bonuses, rose to 6.6% in the second quarter, way above the inflation rate. We've also seen the start of interest rate cuts, although this graph will show you that they're still quite high by recent historical standards, and there's a long way to go to get to real interest rate relief. But the positive thing is that there's been no massive increase in indebtedness. And I know that you keep seeing in the media data regarding increase in indebtedness and the number of, but you've got to bear in mind that, and I have to repeat this, that the very factor that income inequality is so high in South Africa results in a two-phase economy where 15% of the population spends 85% of whatever is spent, and 85% of the population spends only 15% of what is spent. So there may have been a big increase in borrowings by the 85% who don't, who are lowly paid or don't have jobs. But the real driving force for economic activity is the 15% who do have jobs, and they seem to be affording to be spending more. And also all those who have pensions are now or retirement funds are in a position to spend more. And we saw in the first 10 weeks of the introduction of the two-pot retirement scheme, 35 billion rand being withdrawn and used apparently mostly for spending purposes rather than for the retirement of debt. And where does that leave us? And you can see from our forecasts that we are looking slightly more optimistic than the IMF. The IMF released its latest forecast growth figures for this year at 1.5%, unchanged from their previous forecast, and 1.6% for next year, more or less in line with that of the UK, better than Russia, Mexico, and the Eurozone, which is below Mexico. It's cut off here, but way below many other emerging markets, and sub-Saharan Africa growth, where we're looking at 4.2% per annum. So that just puts it into perspective. We are slightly more optimistic than the IMF. We're looking at 1.8 and 1.9% for this year and next year, gradually picking up to over 2%. And as I said, there is a significant upside risk. If we could really get our infrastructural investment going, I think that momentum could really lift the economy. We've got a little bit of it going in our forecast of about 4% growth per annum in capital investment, a turnaround from the negative growth that we saw last year. But theoretically, this figure could easily jump into double-digit figures if we really got our investment going. If I looked at the BLSA hopes, they were looking for 100 billion rands worth of capital investment increase, which would represent an improvement of more than 10%. We don't see that happening because of the major bottlenecks that we see on the logistical front, as well as crime syndicates. But it is a more positive picture than 2024, where we think the economy grew by no more than 0.7%. The IMF says 0.8%. Then on the consumption front, you can also see there the relative improvement that we anticipate for the next few years of just over 2% per annum, on the back of lower interest rates, lower inflation than we previously thought, and of course the return to a bit more business confidence and consumer confidence, and as well as the positive impact of the two-pot retirement scheme. Now, where do we sit from a political point of view? And the interesting one here is the January the 8th ANC statement calls for a renewal of the organization, summarizing the essence of it: the need to fix local government and improve water and energy security, all very good, fight corruption and ensure accountability, improve accountability on the part of the leadership of the organization, and the need to promote internal dialogue to ensure unity within the organization, to fight against all this pushback that we keep seeing between the left and the right wing of the organization, the need to promote economic growth to enhance employment creation, and to improve the role of South Africa in developing Africa's economy. All very well and good, but are we actually going to see that being implemented? And and obviously, what we need as a prerequisite is to sort out these logistical bottlenecks as a matter of urgency, to improve water availability, but more importantly, from a longer-term point of view, if we really want to get to 5%, 6%, 7% growth, which is really the ultimate goal to try and attack employment, we need major improvements in 3 of the areas where apartheid did a lot of damage to the country. The first is education, and there we're seeing very little progress emerging. Secondly, spatial inequalities that need to be addressed. In other words, the fact that so many of the people who are working live so far from their workplace, result of apartheid group areas, but that is inhibiting people from actually getting to work, very costly, looking for work, very costly. And on the top of that, it actually acts as a constraint on the formation of small business activity, which is so essential to really start seeing an improvement in employment creation. If we look at other emerging markets, you won't see huge shopping centers and massive projects, but you will see a lot of little shops and businesses and people driven by people working close to home. And that we don't have in this economy. On the positive side, I'm fairly optimistic that inflation will remain relatively low. Yes, in the very short term, we're going to see a pickup from the lows of 2.8% in October and 2.9% in November. I see our forecast for tomorrow's December CPI inflation rate is 3.2%, but that's still at the bottom end of the inflation target range. For purely statistical purposes linked to the sharp fall in fuel inflation this time last year, we are bound to see some pickup in the year-on-year CPI inflation rate. People pointed to the Rand, and I'm going to come to that later and just make the point that a year ago, the Rand was weaker than it is right now. So there is no major imported inflation from the Rand, even at 1860, because a year ago, this time, we were at over 19 to the dollar. And with the euro, we were over 20. We're now at 19.30. With a pound, we were at 24. We're now 22.70 or whatever the case is. So that is not a big inflationary force right now. Slight one in the short term is that oil prices have risen a little by 10% over the last couple of months, and that could see a fairly sizable increase in fuel prices in February, but they will still be way down on where they were in February last year. Also, inflation expectations, as measured by the BER Inflation Expectations Index, have receded to their lowest level in many years. And that's a key factor that the Reserve Bank looks at in order to monitor its monetary policy. And then when you talk about food prices, remember they're very closely linked to fuel prices because fuel prices get passed on by food distributors in the form of higher food prices. And the fact that fuel inflation is so low is helping to keep food inflation at its lowest level in many years as well. And internationally, food prices are still very low. And with a relative stable firmness in the Rand, that augurs well for food prices to remain fairly low. The big risks lie obviously with electricity and water, but also medical aids, insurance, education, still way above the average inflation rate. And wage increases still relatively brisk. And yesterday we heard news of the government lifting its wage offer to public servants from 5 to 5.5%. That doesn't help in the fight against inflation, but it's marginal, really. And at the end of the day, it means, as far as I'm concerned, that inflation is likely to remain at no more than 4.5% over the next few years. And under those circumstances, a repo rate currently at 7.75% is fairly heavy. And it does suggest that there is still scope for the Reserve Bank to cut rates. I thought a month ago that cutting a further 25 basis point cut at the MPC meeting next week was a shoo-in. But actually, it's slightly less certain now than it was, partly because of what's happened in America, and partly also because what's happened to oil prices and the Rand, short-term Rand movements. We're still banking on a rate cut next week, but I can't hang my hat on it as I was doing a month ago. And after that, we believe that there is scope for at least one further rate cut this year, maybe, and another one next year. There is one huge problem, both in South Africa and internationally, in terms of hoping for lower interest rates. And that is the global rise in public debt levels. You can see it here, how public debt as a percent of GDP, I've just shown you US, UK, and France, close to 100%. South Africa's is, of course, much lower at 75%, but long-term interest rates here are so much higher than they are overseas. The good news is that that gap has narrowed slightly in the last year or so. So the risk premium on South Africa's fiscal situation has improved, has diminished slightly. But what we are concerned about is the fear of Trumpian tariffs and tax cuts, which are, if anything, going to exacerbate the public debt in the US. Yes, Elon Musk has been tasked to head up the Department of Government expenditure to cut back on government spending. The intention is up to $2 trillion, but he himself announced last week that that was actually the best case scenario, that he didn't believe that they would get there. They're hoping to, but and we're looking for an increase over the next couple of years of $6 trillion in debt due to Trumpian policies. So that is likely to prevent long-term interest rates from falling all that much. And in Europe, of course, if they are to increase their military spending on the Ukraine war, that is going to keep their interest rates also from falling quite as much as we had originally hoped for. What is interesting is to notice how yield curves have steepened in recent times. Your short-term interest rates have fallen much more than have been much lower than your longer-term interest rates. And that's a bit of a problem, because we're seeing a significant oversupply of treasury debt driving up rates already. And that is one of the areas where I suppose I've become a little less optimistic in terms of making good gains on investments into bonds. I'm a little more neutral now. I think there are risks of capital losses there, which of course would be counterbalanced by high coupon payments, but still you're looking at potentially less of a return than I was hoping for previously. Domestically, the budget deficits remains more or less in line with what was being hoped for. So officially, austerity is still remaining in place. But what I'm still afraid of is the demands for funding of SOEs. Why is the government now talking about coming to the market to list these SOEs? Because it is so scared of what the funding implications would be. And so I don't think one must be overly, and then there are the substantial debts owed by municipalities. And of course, how far is the government going to succeed in resisting the opposition to engaging the private sector to sort out problems? Having said that, our real interest, long-term interest rates are still amongst the highest in the world. And so what I'm arguing is that our long-term interest rates may edge upwards over the next few years rather than come down further. And that will help to provide a nice interest return, but your total returns, including potential slight capital losses, will limit the amount that you can make on investing longer term. I still think it's an attractive investment option for a significant amount of your money, but not quite as bullish as I was previously. One of the factors that, of course, is of concern is the strength of the dollar. And the reason given, obviously, is because US economic growth is superior to that of other countries. And that is forcing the expectation that US interest rates will remain higher than those of other advanced economies. And that has contributed towards strength in the value of the dollar, and especially now with the fear of import tariffs being imposed by Trump on various countries. The concern is that they will retaliate, so everyone will end up paying more for the goods that they import, whether it's the Americans importing from elsewhere or others importing from the United States, and that will necessitate interest rates remaining higher than would otherwise have been the case. Particularly pernicious in respect of Mexico and Canada, where the threat is of 25% tariff increases. And it was fascinating to see yesterday how the moment a report came out that Trump was not necessarily going to raise tariffs on imports immediately, but was instead going to introduce a study of trade relations between the US and other countries before actually deciding on what tariffs to increase. Suddenly the dollar fell by 1%. That has pulled back again this morning a little, but the implication is then that the rise in the value of the dollar is, of course, helping to quell some of the other potential inflationary pressures from strong economic growth and import tariffs that the United States might have enjoyed. But on the other side, you ask yourself how much of the dollar's recent rise has already discounted the impact on inflation of the increase in import tariffs. It's almost as if the exchange rate markets have downgraded the exchange rates of all the other victim countries of import tariffs so as to keep the relative competitiveness of those countries with the US more or less constant. But the general rate cut expectation is that Europe being a lot, and the UK being a lot weaker than the US, will cut interest rates by more than the US, and therefore that will exert some upward pressure on the dollar. Against that, as I've said, the dollar has already risen by between 7 and 10% since the expectation emerged of Trump winning the election, and that has neutralized a lot of the benefit for the dollar that might otherwise have happened. Obviously, emerging markets have taken a knock because the because higher US interest rates negate the benefits of the carry trade, and so the rand has taken a bit of a knock as a consequence of this. That brings me to Trump's policies, and should one be positive or negative, all I can say is one remains extremely uncertain because there are massive ironies and contradictions in his policies. Firstly, why does he want to impose import tariffs? And the argument is because the United States runs a perennial big trade deficit with other countries, especially China. But as I've said, the dollar has already gained 7 to 10% based on this threat of tariffs. And so that has neutralized a lot of the potential gain in competitiveness that might have arisen from imposing those higher import tariffs. So in many ways, Trump has actually shot himself in the foot. And it creates an environment where other countries will retaliate and reduce economic growth for both the US and the other countries globally. This reversal of globalization stands to remove key driving forces for economic growth. The one exception right now is China, where the yuan at 7.27 to the dollar has hardly depreciated against the greenback. And so imposition of tariffs on China will have not yet been fully discounted. But then I think Trump seems to be almost getting nervous about imposing tariffs on China. He had a chat with Xi Jinping last week, and who knows what went on there. Then, of course, the clampdown on immigration and deportation stands to increase wage inflation in the US and drive up costs there and through the rest of the world. Slashing corporate tax rates, great for business, but and aimed at boosting investment, which it probably will do. He was very proud to say in his inauguration speech that Tim Cook had promised a massive investment of $3 trillion or something by Apple into the US as a consequence of this. But corporate tax rates were already slashed during his first term of office, and this runs totally counter to his objective of keeping, helping the poor at the expense of the rich. Big corporates are assisted. And in yesterday's inauguration, he put the 4 leading heads of the Mag 7 companies to sit in front of his own family at the inauguration. And I thought, what a message to send. Yes, that he's going to help big business, wonderful for markets. But really, I thought most of the support for Trump came from the man in the street who thought that Biden's policies were acting to restrict the well-being of the man in the street, whereas actually Biden was the first president in US history to preside over an economy that created jobs in every single month of his presidency. All right, apologists will say, oh, but that's because of the recovery from COVID, it helped him, etc. Another big irony or contradiction is Trump's threat to impose punitive tariffs on BRICS countries should they work towards replacing the dollar with a BRICS currency. Well, you know, that's a has-been a discussion already. That was discussed at Rio de Janeiro in 2023. In Moscow 2024, the BRICS summit, they didn't even discuss it because they realized that, you know, it's also pie in the sky. But it just shows the kind of obsession that this man has, which is really very worrisome and can create a huge amount of volatility. Denial of climate change, LA wildfires, denying that climate change has anything to do with that. And now he's trying to reinstate fossil fuels in a big way and even act against wind energy in California and blaming the Californian government for ineptitude because it's a democratic government to actually do its job. So there's all sorts of contradictions there. And finally, Trump has kept saying he wants lower interest rates and a weaker dollar to help competitiveness, and his policies, instead of working in the opposite direction, are working towards higher inflation and higher interest rates because of larger public debts. So it's going to be, and we've seen it in the last days since his election, an environment of high levels of volatility that we're going to see. Very uncertain environment, and an environment in which the rich will get still richer. It's a new theme that is really coming through time and time again at the moment that I would like to spend a bit more time researching. But I saw yesterday a report that the wealth of the top 5 billionaires in America has increased by $2 trillion in the last year. And the wealth of the top 1% of America's wealth pyramid has increased its wealth by 50% in the last 4 years or something like that. And the man in the street is not feeling the benefit. And this is driving political polarization. And the youth are finding increasingly that they cannot afford to buy their own homes in the way that their parents did. And this resentment is leading to polarization, both either towards extreme right or towards extreme left. And that is not an environment conducive towards sustainably higher economic growth. Obviously, this environment is wonderful for the tech industry, and we can see here how the Magnificent Seven have completely outperformed the other share indices. But and we know that valuations are ridiculously high. But you know, given this tendency to keep helping the wealthy, could perpetuate this bull run to be even more. I mean, bull markets are characterized by going to huge levels of overvaluation. But in this case, it could be to an even higher level of overvaluation than we've been accustomed to because of the kind of policies that are being introduced by Trump. Also, deregulation and lower taxes. Yes, it will enhance earnings potential. But as I say, from a longer term point of view, it creates an environment in which a counterforce will start slapping back, and you go back to a democratic government in due course. So that is the kind of environment that one is rather scared of. So in other words, I'm saying equity prices are extremely overvalued, but could rise still further. Bond prices are vulnerable to increases in bond yields as a result of the high debt levels. So what does one do with one's money? The answer is one has to diversify. You can't be out of the equity market because of the possibility that there's still potential for overperformance, and many leading houses are predicting the S&P at 6,600 or even 7,000 by the end of this year. But on the negative side, there is a significant chance of substantial corrections if we're not careful. And so diversification has to be the name of the game, and alternative investment options are also a possible, an alternative that we need to look at. I'm sure Steph will talk around that. Finally, the Rand. I mentioned how the Rand has done fairly well over the past year. It has weakened most recently and then strengthened a little. But on a real trade weighted basis, it remains extremely undervalued. And that really means that I don't see the Rand falling very much from current levels. It could go back to 19, just over that for a short period of time. The big negative that we face is potentially slower growth in China and a fall off in South Africa's commodity exports. There's also fears of Trump retaliating against South Africa's political stances, and concerns that our growth rate is just not enough to stop unemployment from increasing still further. Obviously, in the short term, we had the unrest in Mozambique that may have had a role also to play in this latest fall in the value of the Rand, as well as the fact that international investors are starting to worry that if we cut rates too much, then it will neutralize the attractions of the Rand. So for all these reasons, you can't see the South African currency gaining too much ground, but we are still running a trade surplus. Our real interest rates are still high. There are hopes of for a lifting of the grey listing, and the currency remains extremely cheap, and political stability continues to prevail. So, and dollar strength is not a foregone conclusion. That leaves us with a forecast of the Rand somewhere between 17.5 and 19 to the dollar on average over the next year or two, gradually moving towards the 19 level, in line with the low growth and increases in our public debt that we've got. But we don't see any major sell-off in the currency. On the contrary, there is an 8-year cycle within the Rand, and we hit the last low point in May 2023. So it's still early days that the currency could still appreciate on a real trade weighted basis a little bit more in the next year or so. But notice that every rally becomes weaker and weaker, and that is because people realize that our economic growth performance is subpar, and therefore under those circumstances there's no point in pushing the currency too high.